Welcome back to the Retire in BC podcast. Today we're talking about everyone's absolute favorite topic and one I'm sure you've all been just dying to hear about, insurance. Yay! Uh, all jokes aside, risk management, it's an important and often overlooked part of a financial plan. And it's important to make sure that you've given some thought to the protections you've put in place should the worst happen. For a lot of people, insurance tends to be an afterthought, but it can be a very useful tool for maximizing the value of an estate. And if someone has a spouse or kids, especially young ones that are depending on their income, insurance becomes extraordinarily important and really should not be overlooked.
Yeah, it can get a little bit morbid planning for the worst. And from our end, um, insurance salespeople are like just one notch above used car salespeople in terms of the trust level. So trust us, really. We know what we're talking about. No, it's insurance is a way to remove the financial burden of your death off of your spouse's shoulders, or off of your family's shoulders, and onto some third party, an insurance company. If you pass away, it's going to be a huge emotional impact for your friends and family, your spouse. Um, and insurance can't deal with that, but it can help take some of the financial sting out of it. And I'll share later on a couple of stories of situations where it's really happened
Yeah,
to
well, and
them.
I sometimes joke about this actually, that wouldn't it be great if insurance actually could take that actual risk away from yourself? Yeah, it feels a bit like a Black Mirror episode, right? Like if you could sign a contract saying that instead of me passing away
Right,
unexpectedly,
right.
the insurance company, like someone on their end does. No, like obviously they can't do that, but what they can do is take exactly that financial burden, the financial sting away from something like that. So,
Yeah.
we're going to get into all of the different types, things like that. Just generally speaking, um, like I say, it's a good way to either protect your income while you're alive and the rest of the family needs it, or using it as an estate planning tool. Because generally speaking, the payout from those insurance policies, like it's generally tax free. It avoids probate. It goes straight to the beneficiaries instead of going through the estate. It's private. Lots of things like that. And especially here in BC, like wills can be challenged sometimes. As insurance payouts, not so much.
Yeah, actually, I heard a will variation specialist speak once, and it shocked me how easy it is to get a will varied in BC. But yeah, you're right. With insurance, that's definitely not the case. Um, uh, Quick story here. Some of you listening in may know I had a motorcycle accident many years ago. Heading down near just south of Leavenworth. Hammered on my brake too hard. Won't get into the reasons for that, but ended up doing what's called a high side, and um, went flying off my bike at well above 60 miles an hour, and had the once I stopped sliding along the asphalt, I had the presence of mind to jump up, get run over to the side of the road, and my buddies that were all with me, they stop. Of course, they come and they get me, and one buddy in particular gets me up, and I'm ashen, right? I can barely stand. I was okay. Well, found out later I had a broken ankle, but I was okay. But I'm ashen. He gets me standing up, and he gives me this double high five. And somebody took a photo of that, and I so wish I could find that. If you're listening and you have that photo, if you're one of the people who were on that ride with me, I want that photo because it really highlights the not just the celebration of survival, but highlights the need for life insurance and disability insurance because I was mildly disabled, and but also critical illness insurance. And we'll touch on all three of those, but life being the main focus of this. The thing is, crap happens. Sometimes life doesn't happen the way we expect it to, and Ben mentioned, life insurance earlier for the younger set, but also sometimes for the older set. I like to say to people, look, when you're younger, life insurance is a need. You have to look after your family. Later on in life insurance might be a want as an estate planning tool. Maybe you don't need it, but it can be useful. And so yeah, we'll chat about that a little bit too.
Yeah, well, and to dive into that topic a little bit on who needs insurance, well, and who needs it and who wants it, kind of thing, is that at the end of the day, not everybody does need it.
Right.
I personally don't have life insurance right now. I'm single, no dependents, no nothing like that. There's really not that much reason for me to have it. Um, and so I think what I'd do for our viewers, if you're kind of doing a self-assessment on whether or not you need insurance, I just ask yourself the question, if I passed away today, I'm worried about how my spouse or children would manage for XYZ amount of time. And you can fill in that amount of time yourself. Maybe it's until the kids turn 18, maybe it's until the mortgage is paid off, maybe it's until retirement. But if you're worried, if you're not sure that without you they'd be able to maintain the same standard of living, you probably, need is a heavy word, but you need to at least look into it and make that conscious decision about whether or not you want it. Um, or if you're thinking about it more of an estate planning tool, that's kind of an aside that, again, we'll get into in a bit. But how do I transfer my assets in the most tax efficient way possible? Now we've shifted from income replacement to an estate planning tool.
Well, and you say needs a heavy word, and you're right, but quite frankly, it's irresponsible not to
Mhm.
do it. It's it can be quite cheap, and we'll get into
Yeah,
that, but
yeah.
but
Well,
really, yeah,
yeah,
you need it.
actually, and so last week I was at a friend's house there, and I just found out they're expecting their second kid. And I've been, for lack of a better word, hounding these clients for their first kid. And I've been saying, you guys need insurance. Like, actually, I've been pretty good about it. I haven't hounded them too much. But I'm sitting there and I had to control myself because I don't want to be the guy selling insurance at a party. But just as soon as they said that, I'm thinking, like, here we go again. They needed insurance before. Now they really do with the second one on the way, and with no coverage already in place. To your point, I would consider it irresponsible to not put it in place.
Yeah, and I can tell you, and I should full disclosure here. I have given up my insurance license, all of my insurance licenses. So I'm not currently not insurance licensed. Ben handles all of that for us, but I have maybe some more stories, and I can say flat out, I can think of a couple of situations right off. I can't give you names, of course, but right off the top of my head where I maybe wasn't forceful enough where, I presented some insurance to some clients and tried to get them to buy it and they didn't. And they passed away and they were young and their spouses really did suffer. In one case having to go back to work. In another case, she was okay, but probably would have not wanted to continue working in that scenario. Only, I think about 5 years left. It probably would have been better for her to not have to do that in that case. So I can think of a handful of cases where people didn't get it. And really, it doesn't have to be that much. Or cost that much, and when you're in a situation where people are relying on your income, that is when it's really that need.
Yeah, well, it's a bit of a tricky line or a fine line that we're walking between making the recommendation that we really think you should get this and here's why, and kind of bordering that I don't want to be pushy, certainly. To your point
Hmm.
earlier, insurance salesmen
Yeah,
are some of the lowest trusted
yeah,
professions that we have here. And frankly, I think part of the reason for that is that there's this inherent, unavoidable conflict of interest with insurance where
yeah.
just frankly, the more we sell you, the more of a payout we get.
Right,
It's just
right.
there is no way around that other than to disclose that and give solid recommendations for why you're recommending what you are. So, hopefully we can chat about that with clients and kind of come down to it. I think at the end of the day, too, a lot of it is education based. Here's why we think what we think, and then go and
Right.
make your own decision. I touched on it earlier at the beginning, but really it's just I want to make absolutely sure that clients are making a conscious and informed decision.
Yeah.
And if they can say that, yes, we've made a conscious and informed decision not to get insurance, that's okay. We may think it's irresponsible, but that's absolutely their prerogative.
Right.
Right. So, um, in terms of though there how much insurance you need, I think the really simple calculation here, and we have more complicated calculators like we always do, but to give you the really simple version of it, is when I asked you that question before, how long do you think you'd be worried about the dependents living without you? If that was 20 years, let's say, just take your income right now. Let's say that's 100 grand, take off a little bit for taxes. So take your net income, let's call it 75 grand. If you're paying on average 25% tax, multiply that 75 grand by the 20 years that you think you're worried about. Well, right there, there's 1.5 million in potential lost earnings that your spouse and kids would have to take. They would just be missing out on those earnings if you passed away unexpectedly. So that would be a pretty good starting point for the insurance. Do you need exactly that whole amount? Maybe not. Maybe you could bring it down from there. But at least that gives you kind of in the ballpark of what you'd be looking at.
There was a really great book. Well, it's still out there. Lots of people know it, but The Wealthy Barber. It's not as popular now as it was a while ago. But I still remember the chapter on insurance in that book, where the guy said flat out, the amount of insurance that you need is way more than you think you need. It's a big number. And just outlined by your very simple example there, I think that highlights that. Fortunately, certain types of insurance. Now they're temporary, and we'll talk about term insurance. The common is 10-year term, 20-year term, but it can't. That term insurance can be fairly cheap. Problem is, it doesn't have a value later on. So it's like your car insurance. It's, if you don't use it, it's gone. But it is protecting you during that time period. So just as a quick overview, there's multiple types of insurance: term, whole life, universal life. Um, the most commonly sold policy and the most common ones that we sell here are term insurance policies. There can be reasons to buy the other kind. We're not putting any of them down. But the cheapest is 10-year term. 5-year term is less common, but that's even cheaper. But the cheapest is 10-year term, but you can also get it for 20 years or 30, or term to 65 or term to 100, which isn't really term. But all that means that the term just means you are insured. Um, you are guaranteed to be insured for that time period as long as you make the payments. The insurance company can't refuse you. Once they've approved you for that policy, they can't refuse you in year 3, even if you get cancer or whatever it is. You're golden. You get to maintain that policy as long as you continue to pay it.
Yeah, yeah, and well, and the point here is to match the product to the actual need, right?
Right.
And so that's why we went through that exercise of how long do you think you need coverage for? Well, if the answer was 15 years, then they make 15-year term policies. That might be the appropriate thing for you. If the answer was it's an estate planning tool, that's where we move beyond the term insurance and maybe look at the permanent insurance. But exactly, typically the term insurance is the cheapest way to get covered. You're covered for that set period. And that's actually, you already touched on it, I would say shockingly
Yeah. Yeah.
inexpensive. Like it's for a healthy person, especially a healthy young person, you're pretty unlikely to pass away in the next 20 years. The risk is there, and so it's worthwhile defending yourself against it, but it's pretty cheap actually for the insurance company to cover that financial burden. I actually just ran one for myself just in preparation for this, just to give a ballpark of those numbers. It's going to vary between age and gender and things like that. But for reference, I'm turning 32 shortly, and I just ran a $1 million policy, term 20. It came out in the range of like 600 to 700 bucks per year. So like I pay 50 bucks a month and I'm covered for $1 million for the next 20 years. To me, again, that's shockingly cheap. I'm shocked every time I run one of these and I'm like, oh, that's actually very inexpensive.
Well, and the other thing that it's worthwhile, I think, noting is that it's not, you are not locked in for that 20 years.
Right.
The insurance company is, but you are not. And so it's up to you whether you want to continue to make that payment. So if in year 10 you win the lottery, you pay off your mortgage, everything's golden, well, you just stop paying it. You don't have to do that anymore. The other thing I think is worthwhile commenting on is we have a tendency to, I say we, I'm not insurance licensed anymore. Uh, Ben has a tendency to um, uh, offer term policies that are both renewable and convertible.
Right.
And that also provides some extra protection. I don't know, Ben, I should have looked better at the agenda. Were we going to talk about renewable and convertible later on?
We do, yeah. So I've written down here that I would think about it as being covered for that 20-year term. And then probably you're going to let it lapse and not recover.
Right.
But really, what happens there, and I think this is where you're going, is that a renewable policy, it doesn't just disappear at the end of those 20 years. It renews at a way, way higher price. And so that's where I would think of it. You're probably going to cancel it and not take that way, way higher price, but you have the option to let it renew at that more expensive premium. And you're going to do that if you've been diagnosed with something
That's
terminal.
right.
If you still need the coverage, like if you've been diagnosed with a life-threatening cancer in year 19 out of 20, you still want to hang on to the coverage, even though it costs 5 or 10 times as much. Right. So,
That's
so
right.
that's kind of
That's
how I
right.
would think of
Yeah.
it as an option
Yeah.
to
Yeah.
extend.
Well, and also an option to convert it to something permanent if you decide that I don't need it anymore, but now I want it for estate planning purposes. You can drop the
Mhm.
amount and make it a permanent policy. So we try to do things that give you as much protection as possible, but still all the options that you can possibly get.
Yeah, and I had touched on it before too by saying that if you're healthy, you get this price. Not everyone's going to qualify for that, right? And the way that they do that is just that we run a quote based on somebody being in good health. Typically, then the insurance company is going to want to verify that you're at least in reasonably good health. Usually, they're going to do a short questionnaire, a phone call, and then depending on if anything comes up in that phone call or depending on the amount of coverage, they may require more, like a doctor's note, like a urine or blood analysis, so on and so forth. Right. But
Well, and it's becoming more and more common for insurance companies to provide actually preferred rates for people being really healthy.
mhm.
Makes me a little bit worried that we're going to get into this genetic testing thing and people are going to get denied, just because they got bad genetics. I don't know. That's a whole other ball game there. But yeah, I mean the quote that you ran for yourself, I'm presuming that was a standard quote. Being healthy, there's a very good chance that you would end up paying 20% less than that.
Right. Yeah.
Yeah.
Yeah. Yeah. And so, as time goes on too, I'm kind of tending to run typically slightly towards the longer terms. If you think you need 10 years of coverage, maybe get a 15-year term. If you think you need 15 years, maybe get a 20-year. You don't have to do that. Obviously, it's cheaper to get on the shorter term. But I'm just imagining that, in those later years, you do get diagnosed with something, but it's not life-threatening, right? And so what if I get diabetes in year 19? Now, I'm in a bit of a bind if I still need coverage because I can let this new one renew at the way higher price, or I can look at other coverage, but now that I have diabetes, it's not going to be very cheap either. It's also going to
Right.
be more expensive. And so there's a little bit of risk left on the table if you're going to shorter term. Again,
And
that can be a more cost-effective route,
and
though.
there is a tendency for us as people to make more and more money and become better off and for a time period for our insurance need to actually go up. And then consequently, sometimes that also means longer than we
Mhm.
originally thought. So it is true. At least my experience had always been that people end up in later years wanting a little bit more insurance for longer. So erring a little bit if you can afford it, erring a little bit on the longer side and the higher side. I
Yeah.
agree,
Well,
makes
yeah, I
sense.
found that too. I mean, even just thinking about $1 million of coverage for 20 years, well, 15 years from now, inflation has eaten away at that and your income
Exactly.
has gone up, right?
Yeah.
So,
Yeah.
on that note too, I had kind of skipped over this, but typically you're most often going to buy a level insurance. It's just straight for that whole time. You can, if you want, do declining coverage. So like I've seen them, you get 1 million and then it declines to
Right.
500 over that time. For the reasons we've mentioned, I don't necessarily recommend those, but that's going to be cheaper than the full one. Or in the case of permanent insurance, it can do the opposite. It can
Right.
grow over
Right.
time because you've got an investment component. So yeah,
But that's
lots of
kind of
different
the
options.
great thing about that 15-year term or the 20-year term is when it's up, you can choose to renew it or to get a new policy at a lower amount if you've paid off your mortgage or reduced your mortgage and you just need less. So you don't need to have a declining amount. You can decline it yourself or reduce it yourself whenever you want. Yeah. Yeah. So,
Yeah.
I talked about a couple of bad stories where people didn't have enough insurance. I also want to just talk about a couple, and again, I can't get too much into details here, but I've had personal experience of a couple of people losing their spouse, having had a fairly good amount of insurance. And again, here I can think of two examples. One where the person just quit working, and um, was still devastated about their spouse passing away, but that money really allowed them to do the things that they wanted to do without having to go back to work, and just eased that pain dramatically. And years later now, there's still some pain over the loss, but that person is able to live the life that she would have been able to live had the two of them been together financially, not emotionally, but financially, and able to move a little bit forward. And then another case where the person decided to go back to work, but they didn't have to. And that made all the difference in the world because they didn't go back to the same job. They went to a different job. And they were able to move to an area where they enjoyed life more. Um, and so in both of those cases, it was the insurance that allowed that to happen. And had there not been any, those people would have survived, but it would have been much, much harder dealing with the loss and the grief and also having to deal with the money challenges. And so it really is just, it's a need, in the early days. It really is.
Yeah, and as you were telling those stories, I actually just thought of something that segues nicely into our next segue here, or next topic. But it's just that I have heard of cases where, even if there aren't young kids, but there are spouses, where they have co-qualified for a mortgage using both of their incomes. One member passes away, and they didn't have insurance. Now all of a sudden the bank is looking at the surviving spouse and saying, "Well, hold on, your income isn't large enough to qualify for this
Right.
mortgage that the two of you
Yeah.
were paying for." And so I have heard of cases where the surviving spouse does not qualify for the mortgage on their own, and now not only are they devastated by the loss of their spouse, they are booted out of the family home because they can't afford the mortgage on their own.
Yeah. Brutal.
So yeah, brutal. And again, that kind of segues into our next topic nicely, which is just contrasting covering yourself with life insurance on your own, eh, maybe for the purposes of covering the mortgage, maybe for something else, versus sometimes people are pitched mortgage insurance by the bank. And so I did just want to touch on that briefly. Usually, I'm recommending actually just getting the individual life insurance separately for a couple of major reasons. Uh, that mortgage insurance, by the way, I'm also here making a distinguishing something, I don't know, between mortgage default insurance and mortgage life insurance. So default insurance, like that's where you're talking about CMHC. Oftentimes it is mandatory based on the amount of down payment do you have? That's not what we're talking about here. We're talking about actually mortgage life insurance that if you pass away, the mortgage gets paid off and paid to the bank, right?
Well, and I think actually that's the key phrase, and they don't call it that. They call it mortgage insurance. But it's really important to understand that life insurance and mortgage insurance are both life insurance.
Mhm.
The difference is the mortgage one is the bank's offering it, and they've got their own set of rules and strings attached to it. But either way, both of them are predicated on you dying. If you die, there's a payout.
Yeah.
And with the life insurance, you're the one, or you get to choose who gets the payout. If it's mortgage insurance by the bank, they get to choose, and if
Mhm.
they choose themselves.
Yeah. Well, and that's it. So I think when you go and get your mortgage and then they pitch mortgage life insurance to you, it sounds kind of enticing. And if you've listened to our podcast on why you need life insurance, you're thinking, oh yeah, that makes sense. Maybe we want it. But just three really quick reasons why it might be better to pursue the individual policy. Number one, the mortgage or the bank product, they're not factoring in your health at all. They're just giving the same rate to everyone. So when we talked earlier about doing the health interview, yeah, that sounds kind of like a nuisance, but it exists to qualify you for the best rate if possible,
Yeah.
right? Um, Whereas by contrast, just through the bank one, same rate offered to everyone, which, you may or may not have qualified for a better rate on your own.
Well, so if you're a smoker and you're obese and you've got diabetes and they'll give it to you, it might be worthwhile,
Right,
right?
right. Yeah,
But but
exactly. Yeah.
but for most people, it's not a good
Yeah, yeah.
deal.
Case by case. Number two, because it's covering the mortgage amount, your mortgage declines as over the amortization period, right? Over the 25 or 30 years or however long it is. So your actual coverage amount is also declining along with that amortization rate. You're only covered for however much principal is left on the mortgage. Meanwhile, you're paying the premiums typically
Yeah, your
fixed over
payment's
that
the
whole
same.
period.
Yeah.
Your payment stays the same, but the coverage is declining. And number three, like we just talked about, it's covering the bank, not you. So your dependents don't have a choice. That money is going to pay the bank to pay off the mortgage. They're not able to use it for anything else.
So I guess we should move on to permanent insurance. There used to be this outfit. I can't remember their name now, but they made their entire shtick. They're still around. They used to be called A.L. Williams. Now it's something else. But they would, their whole shtick was convincing everybody, um, buy term and invest the difference. And they would go to people who had whole life insurance and universal life insurance and would convince them that those things were evil and they should sell that, get a permanent or get a term policy, which is cheaper, and invest the difference. And frankly, in many cases, they were right, but not all cases. And I think that's the differentiator is there is no evil insurance. Insurance companies are around to provide um, a service or a product, something to help you mitigate risk. And um, and they have a whole bunch of different products. And depending on your need, some of them are applicable. Be very wary of anybody that only has a hammer and treats everything like it's a nail. That's just not realistic. For most people, term products probably make the most amount of sense, but there are lots of cases where universal or whole life can make some sense. Uh, but Ben, you want to explain sort of what those are?
I do, but I just want to reiterate what you just said, because I think you nailed it, right?
Yeah.
Is that it's exactly, yeah.
Yeah.
Is that it's situational, right? It's these products exist for a certain feature. You need to look at what's right for you. And so if before we said that you had a temporary need for income replacement while the kids are young, then you probably want term insurance and you probably don't want permanent insurance. But um, if you're looking more at the when I pass away, not the if I pass away, when
Oh,
I
that's a good
pass
way of
away, I
putting it.
want to
Yeah.
leave stuff, to the next generation. That's where permanent insurance can really, be a good thing. Such as, okay, I want to leave a specific amount to each of my children and I want the remainder of the estate going somewhere else. Or the opposite, I want a specific amount to go to charity, and I want the rest of the estate to go to the kids. Or I own the cottage, the family cottage, and I'm worried about when I die, there's a deemed disposition, there's going to be this huge tax bill. Maybe I want to apply some of the proceeds of life insurance so that when I die, that tax bill is taken care of. Right. So it's just things like that. I think for the purposes of this podcast, I'm gonna lump universal life and whole life mostly together. There are minor differences, but both of them are those permanent insurance products. I think case by case, if we're talking to someone, I'll go over some of those details. But for here, just talking about permanent insurance, generally
Right.
speaking.
Yeah.
And so the major features here are when we talked about term insurance, I said it's pretty cheap because I'm unlikely to pass away in the next 20 years, right? When we switch our focus to permanent insurance, I'm guaranteed to eventually pass away. The insurance company is guaranteed to pay out the cash surrender, or sorry, the face value of the insurance, assuming that I keep the policy in place and I keep paying the premiums and so on and so forth. And so because they're guaranteed to have to pay it out, well, it's significantly more expensive, right?
Yeah. Yeah.
But you're covered for life as long as you keep paying it. Then alongside there, let's say I did want to have it grow over time. This is the kind of thing where you can make it a little bit more flexible. You can have the insurance component, and within that insurance policy, also include an investment component. So you can kind of overfund it, pay for the insurance and then some, and build up this investment component over time as well, really to maximize that and get more payout to the next of kin. Because as we talked about earlier, life insurance proceeds are tax free. It is and they avoid probate and they avoid going through the will and all sorts of things like that.
Yeah, and you can, create those hybrid products that have term and permanent. There's a gazillion different options, and there's also some benefits inside corporations. So, beyond the scope of this, but
I
well,
did just want to say too, like when you were talking about some people have been sold permanent insurance that probably shouldn't have, that should have
right,
sold it and moved it
exactly.
over. One specific case that I want to talk about that, I mean, I say specific, but it's all too common that I see is someone shows me their universal life or whole life policy statement, and I'm looking for the words either level cost of insurance or yearly renewable term, YRT. And the reason that I'm looking for that specifically are that within that policy, there's like just for accounting purposes and whatnot, the insurance company breaks it up into the actual cost of the insurance that they're providing you. And then, like I'd said before, you can overfund that as well and shuffle more money in there. If you have level cost of insurance, what that means is that they've projected throughout the entire life of the policy of your life, the cost of insurance is going to stay exactly the same. Or, that's not quite true. It depends on their experience with other people in the same age category and risk categories and things. But it's not projected to rise again and again and again as you age, right? So that's what I like to see usually because we have a bit of a better handle on what's going to happen moving forward versus if you have yearly renewable term cost of insurance. Now they know that each and every year you get older, you're more likely to pass away, and so the actual cost to insure you goes up. And it goes up exponentially, more and more and more every year. And so all too often I've seen people, their advisor showed them this policy and projected that you're going to deposit such and such amount every month. And eventually, by the time you retire, the investment component will have grown so much that it's going to take care of the cost of insurance. It's going to be great. But two things happen. One, the investor sees that, oh, it's actually a lower cost of insurance. I don't have to fund it that much. So this is a little bit of I'd say user error, but it's just not understanding the policy or the advisor not doing a good job of explaining it. And so they underfund it. And or the investments don't do as well as have been projected, and or the cost of insurance goes up more than you think. And so you just end up in a place where the policy is underfunded, the cost of insurance keeps going up year over year over year. You're now retired and can't afford to keep paying for all of these premiums, and you have to cancel the policy eventually. If it gets to that point, even though it's just an inefficient and poor way of doing it. I would have preferred to see more education and a more responsible advisor sort of putting that in place in the first place.
Well, it's sort of the equivalent to us telling a client, oh, you're going to make 15% a year in your investments, right? Like, I mean, it's making a projection that just isn't that realistic.
Mm-hmm. Mm-hmm.
Yeah.
The other thing then I was just going to touch on that too is that if you're going to be thinking of permanent insurance as a estate planning tool, if you're doing this kind of permanent insurance, typically you want to get that in place kind of in your 70s probably, or earlier, right? You could always do it earlier. Just that after age 80, it starts getting a bit difficult to actually get that permanent insurance in place. Just based on age, fewer and fewer insurers are actually providing that.
Well, and from a cost perspective, the sooner you do it, the much cheaper it is on a monthly basis, because you've got more time to build that up. So yeah, it is wise to do it much earlier than later. And yeah, at some point you just can't.
Mm-hmm. Mm-hmm.
So just moving on to disability insurance, just real quickly, and again, this isn't really the focus of this, but life insurance is for when you die, it's for your family. Disability insurance is for if you live, and something happens and you can't work anymore, or you're there's very specific definitions about when you qualify or not. But disability insurance is more about you; it's for you. And so if you can't do your work or you get certain diseases, you will automatically be granted a certain income. And
I mean,
it,
I might even push back on it being for you and not for your family. It's also for your
oh,
family
okay,
because,
yeah, yeah,
well, just contrasting with the life insurance, if you pass away, okay, there are the lost earnings. If you get disabled, there might be those same lost earnings, and also now you're a drain on the family finances because
right,
you have these
right,
medical
right.
expenses, and
Okay,
so
fair enough,
well, I just like
fair
to
enough.
highlight that it's like potentially even worse
Right,
for the
right,
household finances to
right.
get disabled than to pass away in a way, right?
Yeah, yeah,
Sometimes you
yeah,
can find some work or whatever,
yeah.
but just in a way, it's worthwhile looking at disability just as much, if not more so, than it is for life insurance. That being said, um, if there aren't those dependents, then you're right. It's still
Right,
worthwhile.
that's right.
A single person with no dependents probably doesn't need the life insurance. They probably should still be looking at disability.
Exactly. Yeah.
Yeah,
Yeah.
yeah.
Yeah. Yeah. And the other thing I'd comment on, just from personal experience, I have seen that um, uh, employer plans where you're covered through your employer um, aren't as good as private ones, hands down. Typically for well, a whole bunch of reasons, but the employer ones sometimes are taxable. So Ben mentioned earlier, insurance proceeds aren't usually taxable. That's always true as far as I'm aware with life insurance, but with disability insurance, it depends on who's actually paying the premium. If your employer is paying the premium, it will be taxable to you if you got it. The other thing is though. Um, Typically after a couple of years on a disability claim, if you have a permanent disability, on those employer plans, my experience has been insurance companies push back a lot harder. They really push to make sure that you are fully disabled. They want to stop making payments after 2 years, very quite consistently. As I've seen that. On the flip side, on private policies, while that can happen, they seem to be far less stringent about it. And so when you're looking at disability insurance, I mean, if your employer's offering it, that's great, you've got it, but you may want to consider putting some sort of add-on to it or something like that, because particularly after 2 years, very often that's it.
Yeah, yeah. Well, and not to get too into the weeds here, but I do just want to add to that too, that when you're shopping around for a disability insurance policy, just that some things to watch out for are that you can change, like, if I get disabled, this one will pay out for only 5 years, and this other one will pay out the rest of my working
That's
career up
right.
to age 65. You can change around like the waiting period. This one will kick in after I'm disabled for 90 days. This one's 120, or oh, I want it to be a cheaper policy, so let's make it 180.
Well,
So there are a couple of things you
think
can,
of the waiting period like a deductible,
yeah,
right? Like, I
yeah,
mean,
no,
it's
exactly.
effectively a deductible. I'm not going to make a claim during this waiting period. And the bigger your deductible, the cheaper your insurance,
Yeah, yeah.
right?
And so if you have a healthier emergency fund, then maybe you can have the
Exactly.
higher
Yeah.
deductible. Yeah, no, exactly. And then it's just like there are going to be different tiers for the cost based on what kind of work that you do. So like a construction worker is going to cost more to insure than an office worker, so on and so forth. And you had touched on it before, but there are different occupation classes
Yeah.
um, or situations where they pay. And so, for example, if you're a surgeon, um, it's called own occupation versus any occupation. Maybe this policy pays for 2 years when I can't be a surgeon, but after that, I still can't be a surgeon, but I could hypothetically do other work. So it's not going to pay anymore. I could do another job. You can fiddle around with those definitions and say that, oh, yeah, actually, I want my own occupation to be covered for the whole time or whatever. It's just those different decisions are going to change how much it costs to insure you.
Well,
Right.
and I like to think about it as though, if you're making $100,000, do you want a job that's paying you $100,000 while you're able and zero if you're disabled? Or would you rather get paid $95,000 and while you're able, and what, $75,000 if you're not, like, if you
Hmm.
get disabled, right?
Yeah.
To me, that's a very wise way of looking at it.
Yeah. Yeah, and those costs aren't unreasonable. Like before when we had said life insurance is pretty reasonably cheap, disability is unfortunately not.
Right.
It is pretty expensive. But to your point, it's still worthwhile having because if something happens to you, then at least you have some income. But yeah, it's not uncommon for people to be paying like 1 to 3% of their net
Yeah.
income
Yeah. Yeah.
on that disability
Well, and the
insurance.
odds
So
of you being disabled in the next 5 years are way, 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 way higher than the odds of you dying in the next 5 years.
yeah, yeah, no, exactly, exactly. So excellent. Moving on really quick, we'll just touch on this very briefly, but it's another kind, which is critical illness insurance. That's really something that it's a lot simpler. It's just, look, if you get one of these conditions, heart attack, stroke, so on and so forth, there's a list of covered conditions. If you get diagnosed with that, here's a check, right? Here's 50 grand, here's 100 grand, whatever it is. Doesn't matter if you can work after, it doesn't matter if you can't, it doesn't matter if you're hospitalized. Well, I mean, you have to get diagnosed. So typically that's going to involve a medical practitioner, but, really easy. Just here's the list of conditions and you get a check.
Well, I guess one other differentiator there is disability insurance gives you a monthly paycheck.
Yeah.
Critical illness insurance is kind of like life insurance in that way. They give you one big lump sum. And in fact, actually, I had one case where years ago where we could not get them disability insurance. We couldn't get them covered. And so basically created a poor man's disability insurance by buying them some critical illness insurance.
Hmm. Hmm.
Right.
Well,
So it
yeah.
didn't cover them for everything, but at least they had some
Yeah.
coverage in certain cases.
Yeah. Well, and they can be kind of used as well in terms of, okay, well, I have a disability insurance. I pushed out that waiting period all the way to 180 days.
Right.
Well, maybe I could think of critical illness as if something happens to me, I can use this 50 grand check for the next 6 months or whatever it is, right? So,
Well, and the vast majority of critical illness insurance policies are paid out for I think it's only four things: heart attack, stroke, heart disease, I think, and cancer. I believe those four are all like they represent something like 90% of the critical insurance payouts. So when you look at different coverages, lots of them cover 12, 17, 20 things, but the vast majority is really those four that end up triggering the payout.
Yeah, yeah, well, that's it. I think usually it's like those are the big four, and
Yeah,
then there are 25 covered conditions
yeah,
beyond that or something. And yeah, you're right. It's heart attack, stroke, cancer. It has to be life-threatening cancer,
yes, yes,
and I think some kind of heart surgery, heart bypass, or something like that.
yeah,
So.
yeah.
But anyhow, so that's that. Then just, yeah, really quickly wanted to touch on the workplace benefits, which we touched a little bit on for disability. I did just want to highlight that oftentimes I talk to people and they say, oh, yeah, 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 I have life insurance through work. I have seen most often that the life insurance through work is insufficient. Most often I've seen it's one times your income or two times your income, which, as we've talked about already, you probably need closer to 15 or 20 times your income. Um,
Yeah,
Again,
I don't
need
think
is
I've ever seen
relative.
higher than two times ever. Yeah.
Yeah. And so that's just worth looking at. The disability plans you had touched on before, sometimes they're insufficient. I've actually found oftentimes they're okay. They're better than the life insurance. Like they cover more of the need, in
Yes,
my opinion,
yes.
than the life insurance. And then I did just want to touch on you touched on the payment. If the employer pays for it, then the benefit is or the payout is a taxable benefit. Whereas if you pay for it, then it's a tax-free benefit to you.
Yeah.
And I just wanted to highlight, oftentimes too, it's worth checking if that's the first payer or second payer, because oftentimes we can supplement that with your own individual policy, but then the work policy won't kick in up to a certain level. Like oftentimes there's a maximum, all of the policies combined won't cover more
Right.
than 75 or 85% of your pre-disability income, right? So just
Yeah,
worth
actually
looking
I
at
wouldn't
that.
say often, I'd say almost always.
Yeah.
Like
Well,
there's
yeah, I think there's always a limit. It's just that
yeah,
limit
yeah.
changes. Yeah.
Yeah, the insurance companies want to make sure that you're not incentivized to cut off your little finger and not be able to work, right?
Right. Right.
If all of a sudden you're making 120% of what you were making the day before, that's not an incentive they want. And so all of disability insurance is designed for you to not to get close to what you were making before, but not above it.
Yeah. Yeah. Perfect. And so then, yeah, finally, just had a couple of other really quick topics. We'll jump through here. Just wanted to touch on something called segregated funds really quick. These are closer to an investment product, really, in my opinion, but they are technically insurance. And what they are really is it's an investment that's wrapped in an insurance policy.
Yeah, yeah, yeah,
Right, it is the way that I would think about it. But the benefit being that couple of benefits really, but let's say I want to invest pretty aggressively and I'm hoping to build up more of the estate to leave to my kids. Um, but I want some guarantees. You can put it in a seg fund. The insurance component here is that there's a maturity guarantee and a death benefit guarantee. So that might be 75% or it might be 100% of what you put in. So let's say I put in 100 grand into there. The market does its thing. Um, Unfortunately, the market crashes. My investments, when I look at the statement, they're down to 85, and then I pass away. If I had selected the 100% money back guarantee, then it doesn't matter that the investments have dropped to 85. The next of kin get the full 100, right? So that's kind of the major benefit. But secondarily, as well, is that because it's an investment proceed and it goes to them tax free, again, it avoids probate, it avoids going through the will. I just met with someone earlier this week who that is her primary concern is her and her kids' primary concern is to not have anything go through probate and not have anything go through the will. And we are looking very closely at seg funds as a potential opportunity for those estate planning needs.
Well, the other thing, I guess, on the flip side to comment on is particularly when you have those 100% guarantees versus the 75. If you're worried about mutual fund management expense ratios, they're going to be way higher because they have to be way higher on a seg fund to cover off that guarantee. That's the only way that
Yeah,
can
no,
happen.
exactly. Yeah.
So if that's something that bothers you, then seg funds are not for you. But as Ben said, if your whole focus is that guarantee or avoiding probate, um, I'm not sure you want to avoid paying 1.4% once by paying it every year, but that is one feature, one factor.
Yeah, for sure. And then finally, wanted to touch briefly on annuities, which I think we've talked about briefly before as well. But just thinking about it, like if I'm going into retirement, let's say my nest egg is 500 grand, I'm trying to use that for my retirement income, but I don't know if I'm going to live another 15 years. I don't know if I'm going to live another 40 years. How much, I don't know what the market's going to do in the meantime. How much can I pull out of there? That's something that you pay your financial advisor and we help you figure out what's sustainable. But if you want to make kind of full use of that and not leave too much up to chance, that longevity risk and that market risk, again, those are risks that you can offload to the insurance company and say, you know what, I don't want to manage this, you manage this, and just cut me a monthly check, and that monthly check is going to come to you every month forever, no matter how long you live.
Well, and that's
Right.
basically what a pension does, right?
Yeah.
I mean, they basically buy an annuity for you. Um, Usually they're not inflation adjusted. Well, it depends,
So they
but
can
yeah,
be, but then
yeah,
it's going to be a lower. Yeah, no,
yeah.
exactly. And then I just wanted to highlight there too. Sometimes you talk about that and people say, oh, well, what if I put all of this in and then I do pass away right away? Well, sometimes they can then account for that and come up with guarantees. Oh, we will make sure that at least 15 years worth of the payout goes to the estate or whatever it is. So,
But it is important to point out after that 15 years or whatever guarantee period you choose, pick, after that period, your family gets nothing.
yeah.
Yeah, yeah, yeah. All right. Well, let's recap the key points from today. Think carefully about how long you need your protection, and whether you want that to be, or whether you need it on a temporary basis or a permanent basis. Term insurance usually works best for the temporary kind, and permanent insurance is best for that permanent kind, for like estate planning or for leaving a legacy. Um, don't rely just on your work coverage. Odds are it's not enough.
I think
Um,
it's, I just want to jump in there. Like, I
yeah,
just think it's worth having a conversation about. Right.
right,
And so
right.
even if all you do is you bring it to a financial advisor and say, hey, I don't know if I'm covered enough or not, that's worthwhile. And then number two is like we talked about before, just make, have all of the info and make a conscious decision. Don't just let insurance be this thing in the background that you never think about. Sorry to interrupt your intro,
No, no,
Arnold, or
no.
outro, sorry.
But really, overall, my experience has been for the vast majority of people, work coverage is not
Mhm.
sufficient, in one capacity or another. And so sometimes it is, that's true, but that's rare. And so, yeah, to Ben's point, get some advice, get somebody to look at it. But yeah, just don't assume that the work coverage is going to be enough for you. So if you've been putting off looking at life insurance or any kind of insurance, now's a good time to take a serious look. Um, Life insurance might not make the topic of death any easier, but it can make the financial side far less stressful for those that you love. So thanks for tuning in to our Retire in BC podcast. We'll catch you next time with more practical ways to build and protect your wealth and your future.
All right. Thanks. Bye. The views and opinions expressed in this podcast may not necessarily reflect those of IPC Securities Corporation or IPC Investment Corporation. The information provided is for informational and entertainment purposes only and should not be construed as financial, legal, or tax advice. The hosts and creators of this podcast assume no liability for actions taken
based on the content discussed.